Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
I'm Paul Sweeney.
And I'm Emily Graffeo, filling in for Alex Steele.
On today's Bloomberg Intelligence show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll discuss how patients can now get Eli Lilly's blockbuster weight loss drug at nearly 50% discount.
Plus, we'll look at a slew of U.S. retail earnings that are painting a mixed picture of the consumer.
But first, we dive into the earnings from AI giant Nvidia. This week, the chipmaker gave a revenue forecast that fell short of some of the most optimistic analyst expectations.
The outlook threatens to tamp down an AI frenzy that has transformed Nvidia into the world's second most valuable company.
For more, Emily and I were joined by Kunjan Sobhani, Bloomberg Intelligence senior semiconductor analyst.
We first asked Kunjan for his take on the company's results.
Look, there's not enough negatives. Fundamentally, they are a victim of their own recent success and strength and really unrealistic expectations.
I'm wondering, this is a company where a lot of their customers are highly concentrated. Something like 40% of the customer base is just a few big tech companies. What are the risks associated with that?
I mean, look, concentration has been a significant risk. It's sort of a double-edged sword, by the function of spending. These customers are the ones who really spend major IT app CapEx dollars. So you do want them to be your biggest customers because that's who are really creating the market. At the same time, we have seen signs like over the last 2 quarters, the cloud players make up about 45% of its data center revenue, which is down from its peak of mid 50% over last year. So that's a good sign. Over the last few quarters, we have seen enterprises and the consumer internet and vertical companies growing faster for NVIDIA data center revenues compared to the cloud revenues for NVIDIA data center. So that's, again, a good sign. Another third sign that shows that diversification is happening and that risk is easing is what we have seen in from the geographical demand perspective. So over the last few quarters, we have seen rest of the world outside of US continue to sustainably keep growing sequentially. In fact, this quarter was the first time we ever saw US decline slightly quarter over quarter.
So Kunjan, can those new verticals of customers, can they offset what might be slowing demand from the Amazons of the world, the Googles of the world, who are developing their own chips?
So we have not seen signs of slowing demand from the Amazons and Googles of the world. When you look at quarter to quarter, things can look lumpy. But from a year-end perspective, annual perspective, we are not seeing slowing demand. In fact, when we look at this earnings seasons, all of these customers beat their CapEx estimation and guided for more CapEx spending, most of it going to AI, most of it going to NVIDIA. Yes, the risk is there of these customers using their own chips, but that's more of a out-year risk. They still are not slowing down or stopping purchasing NVIDIA chips.
What do investors need to know about the Blackwell processor lineup? Ian King of Bloomberg News said this is NVIDIA's next big cash cow.
Exactly. I mean, from our perspective, the biggest question or the risk going into the earnings was what's happening with the Blackwell delay? Is it going to ramp? And if so, when? I think the comment that Jensen made about $7 billion shipment in their fiscal 4Q should put a lid on these uncertainty around Blackwell. And yes, Blackwell is supposed to be the next growth driver. Specifically, most of the 2025 growth is hinged on Blackwell's success.
Lay out for us kind of how the competitive environment looks out there, Kunjan. I'm thinking about Advanced Micro Devices, Broadcom, maybe to Qualcomm, to a lesser extent Intel, I guess. Where are all these competitors here? Why can't they do this stuff?
I mean, NVIDIA has almost more than a decade of R&D behind them in this arena, right? They are the ones who, for the most part, invented GPUs. They have been working on GPUs for, like I said, investing in it more than a decade. these other companies that we talked about have not been investing in this area. So it's not as easy to come in and immediately replace someone who has been ahead of you by multi-years. Second, there's a lot other entries to barrier. It's not just about creating comparable chips. Their software system, their systems, they're not a chip solution provider anymore. They're a system solution provider. So you don't need a comparable chip. You also need the software. You need the ecosystem. You need the vertical integration and the system integration capabilities. At the same time, they are not just sitting, right? They are running much faster than they have in the past. So it's not just about catching up to Nvidia, which is already 2+ years ahead of its closest competitor. It's also trying to catch up when they are even running faster. One example of that is they are now launching new products at a cadence of 12 months. This is unprecedented in the semiconductor world for this complex technology. Usually you see 18 to 24 months of a product launch cycle.
How about valuation here? Again, you look at it and it's like 70 times trailing, 45 times this year, 30 times next year. Is this a stock that realistically, with a straight face, you can say to clients, is earning its way into its multiple?
Well, so we look at forward-looking multiples, and when you still compare it today compared to most of its peers, right, it's still growing faster than most of its peers, even at this large scale, which is very important that people forget. When you look at other fundamental metrics, the gross margin, the earnings growth, the free cash flow generation, still top of the list. So, I mean, that does demand a certain premium versus its peers, right? And when you look at the other AI peers, it doesn't seem that expensive on a relative basis.
Give us some final thoughts on, is this a market that is only going to be powered by Nvidia, or are we going to see more trading days? The tech trade is kind of, in the green without Nvidia.
I would say both. I mean, you have to really separate out, right? We think if there is fundamental weakness or concern coming out of Nvidia, which did not happen, by the way, we think there will be a broader impact to the market. But in the absence of that, right, there was no real concerns. There was no real flag risks that were macro risks outlined here, that the demand is slowing, the spending is slowing. So I believe until and unless we don't see those risks come out, the impact should be limited to Nvidia. But if and when we do see those come out, it could spread across.
Our thanks to Kunjan Sobhani, Bloomberg Intelligence Senior Semiconductor Analyst.
We move now to the media space.
Producer David Ellison, SkyDance Media, looks set to become the new owner of Paramount Global.
That's after Seagram heir Edgar Bronfman Jr. dropped his bid for Paramount this week. Paramount said it now expects to complete a deal with SkyDance in the first half of 2025.
For more on all this, host Alex Steele and Bailey Lipschultz were joined by Geetha Ranganathan, Bloomberg Intelligence Analyst on U.S. media.
They first asked Geetha for her take on the latest news.
This one's been a tough one, right? It's not over until it's over. I think SkyDance does seem to be, the only bidding party here for Paramount. And, the Edgar Bronfman bid is, and, we were talking about this last week, Alex. It was really a little bit of a head scratcher because they made that 11th hour move. He cobbled together something like 20 outside investors. And then when kind of push came to shove, he really couldn't find the equity financing required to back his $6 billion offer.
Am I reading too much into it to question why the 11th hour offer? Like if it seemed like
there wasn't enough time
there
to do it
wasn't
earlier?
enough time and you're trying to find people and get funding, it kind of, I don't know.
Yeah, I think, a couple of different things. Maybe he had difficulty kind of finding all the different parties interested. Obviously, he didn't, there was a go shop period that was a 45-day period, and he literally submitted it on August 20th, and August 21st was the end of that 45-day go shop period. One could argue that maybe he didn't want to kind of show his hand too early, so that there would be other parties kind of jumping in. But at the end of the day, he obviously does not have the financial firepower of the Ellison family. And that's something I think investors are going to have to come to terms with.
So, all right, let's just walk it forward. You get SkyDance, gets Paramount, etc. There were some reports that maybe some of the TV networks, I'm assuming local, would be spun off or sold, etc. What are we expecting of that sort to unfold?
So they right now have 3 co-CEOs, and this kind of structure, this temporary structure, is going to continue till the SkyDance deal closes, which might happen sometime towards the latter half of 2025. Until then, what they're really trying to do is, number one, is make streaming profitable. They already did do that in the second quarter. So they're really kind of cutting down on marketing spend. They're cutting down on content expenses. They're doing everything they can to right the ship. They're also kind of trying to undertake cost cuts across the whole enterprise and get rid of non-core assets. So the news that we got about them looking to divest some of their local TV stations exactly kind of goes to that strategy. They could potentially end up with about 500 million, about $500 million or $1 billion for those, TV stations. Again, that's going to help them pay down debt. And debt has been a huge problem for Paramount. They have almost about $14.5 billion in debt.
Wow.
And that has really kind of complicated the whole story because they have low EBITDA, low free cash flow, and then very high debt.
And what does the path forward look like? I'm just looking through your latest note, kind of looking at strengthening the balance sheet. To your point, more than $14.5 billion in debt, market cap is $7.6 billion. So you never really want to see numbers that stretched. But what does Ellison's deep pockets bring to the table? Like, how does this potentially revamp Paramount, if at all?
Absolutely. That's a great point, Bailey. So I think the main reason that Ellison has been chasing after Paramount for all these months is really his interest in kind of getting his hands on the studio. So he does have a long history with Paramount. They have, the Ellisons have been a co-financer on many of the Paramount TV and film projects, most notably a lot of the Tom Cruise movies. So they do kind of know how, that business works. They have a lot of expertise. So they are going to kind of double down on the Paramount studio business. The theatrical business is rebounding nicely, so I think it does make sense for them. And historically, if you just look at Paramount, this is, the studio has always kind of been a stepchild. So it's nice that it's going to now come into focus. And then along with that, you have almost 1,000-person animation team that SkyDance is going to bring to Paramount. So really kind of doubling down on the animation business. And this is important because we see studios kind of going deeper and deeper into animation. Animation is one of the most profitable genres across the whole movie space. So it makes a lot of sense for them to get into that in a bigger way because they can really kind of enhance the profitability of the studio business as a whole.
Our thanks to Geetha Ranganathan, Bloomberg Intelligence analyst on U.S. media.
Coming up, a conversation with the executive director of the Port of Los Angeles on cargo volumes and the shipping industry.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Emily Graffeo. This is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I'm Paul Sweeney.
And I'm Emily Graffeo, filling in for Alex Steele.
We move now to the biotech space. This week, we heard the pharmaceutical company Eli Lilly is selling vials of its blockbuster weight loss drug to patients at a 50% discount to its shots.
Patients with a prescription for Zepbound can now purchase a month's supply of single-use vials through Lilly's direct-to-consumer site.
This is being done to help Eli Lilly overcome supply shortages of its widely popular shots. For more, hosts Alex Steele and Bailey Lipschultz were joined by Michael Shaw, Bloomberg Intelligence senior pharma analyst.
They first asked Michael why it's easier for Eli Lilly to produce vials than actual shots.
They're providing a vial formulation. It's something that they've talked about, for a while now on their calls. Now, the reason why these are easier to produce is, the fill and finish capacity. So the capacity needed to actually put the drug in the pens and the capacity needed to manufacture the pens of the subcutaneous injection. So overall, I think, the move is, positive for Lilly, clearly broadens access or patients' access, to Zepbound. And also from compounding pharmacy standpoint, the fact that it improves supply means it could, possibly combat, competition from, companies such as Hims and Hers.
Yeah, Lilly not so subtly saying that they want to aim to protect patients from, quote, counterfeit, fake, unsafe, or untested knockoffs. So how does that impact kind of the business and demand if we're seeing a cheaper version being sold and maybe trying to court some of those Hims and Hers GLP-1 users? How does that impact kind of the total addressable market and expectations for sales of Zepbound?
Well, I think if there's if there's a branded vial formulation out there, and there's obviously guarantees around kind of purity, etc., I think that's going to be the preferred choice. The fact that you're introducing these vials into the market would suggest that some of that supply burden and supply shortage, which is needed for a compounding pharmacy to produce a drug that is on patent, some of that will be alleviated there. So that's kind of why we think it's positive for Lilly. As to whether companies like him and hers will continue producing their versions of the GLP-1s. I mean, that remains to be seen, but I imagine if they do, Lilly will, probably challenge it.
When people then do their own shots, like administer it, like is there a risk in that? Like, what kind of uptake are we expecting from that? Because I would be scared to do it, but maybe that's just me.
I mean, I think judging by what we saw for uptake of these compounded drugs, there's clearly a appetite for injectable injections. Now, we look to the diabetes market, some of the insulins used to be injections. So, I mean, I think there's clearly kind of an increased kind of dosing burden associated with these injections. So they're probably not going to be suitable for all, but, I think there is going to be an appetite for it.
What does this mean for the competitive landscape? So you have Lilly, you have Novo, to your point, you have hims and hers. Like, is this going to create a pricing war, or am I reading too much into that?
No, I mean, when we look at the headline said 50%, discount. But we need to remember that, on a net price basis, so, after taking account all the rebates and discounts, the pricing is probably, fairly similar to the current net prices that we're seeing now. At the moment, it's an underpenetrated market. There's massive demand out there. There's tight supply. So I don't think it's going to, change too much in terms of the dynamics between, Novo and Lilly. I think prescribing decisions are, less about kind of the profiles of the drug at the moment and more about, what is insured, what can people get their hands on.
Yeah.
So near term, I don't see, that changing. From a Lilly perspective, as they ramp up supply over the midterm of their pens, you could potentially see, patients switching from the injectable onto the pen as and when that supply comes on board.
Our thanks to Michael Shaw, Bloomberg Intelligence Senior Pharma Biotech Analyst.
We move next to one of the world's busiest seaports and a leading gateway for international trade in North America, the Port of Los Angeles.
This week, co-host Alex Steele and I were joined by Gene Soroka, Executive Director of the Port of Los Angeles. We discussed his forecast for cargo volumes, the shipping industry, and investing in ports moving forward. And we began by asking Gene what the traffic is at the Port of LA.
We're up 18% year on year off of very modest comps, but we just crossed the 500,000 container unit mark last month, and it's only the fourth time in our history we've had more than 500,000 imports coming through Los Angeles. Big number for us, and it continues the trend that we've seen thus far this year. In addition, exports are now up 14 consecutive months year on year. So the volume as a whole is really great, based mainly on a strong economy and then some geopolitical issues around the world that I'm sure we'll talk about.
Yeah, so Gene, I'm curious, how much are your customers talking about the geopolitics abroad, but also here in the U.S.? Anecdotally, I keep hearing that certain companies are just holding back on investments until we get clarity on who's going to be in the White House. Are you seeing any of that?
In just about every conversation, Alex, it is an election year. And folks are looking to see and try to hedge as to what type of policies will be in place after inauguration. You've got a protracted labor negotiation on the East Coast with the Dock Workers and Employers Association that's coming up for expiry at the end of September. The Panama Canal drought issues have been in the news for well over a year and a half, and the ongoing security concerns in the Red Sea have stymied crossings at the Suez Canal for more than a year as well. All of that put together, fractionally, you see cargo coming to the west coast of the United States and specifically Los Angeles, in addition to the strength of that economy. That shows where the numbers are going.
Hey, Gene, just last week, Bloomberg News published a really in-depth big take story, and it looked at your world ports seaports around the world and how some governments are using them as really strategic tools here because they're becoming so important for global trade. Just for the U.S., do you feel like our ports are where they need to be in terms of, investments, capacity, or does the U.S., whether it's a public-private partnership, need to invest more?
We absolutely need to invest more, but beginning with the Infrastructure Investment and Jobs Act, the Inflation Reduction Act, and now applications that are in front of the Environmental Protection Agency, we've seen a focus on ports over the last 3.5 years here in the United States that we haven't seen in a generation. We'd like to have this type of federal investment budgeted annually. And I also know that the work here in California under Governor Gavin Newsom has the same bent, paying attention to these ports, investing not only in the infrastructure, but digitalization as well as clean and green technologies. This has to continue, but I like the trajectory that we're on right now.
Going back to what you were mentioning about customers talking about election uncertainty, what's your best guess as to what happens after that? I'm trying to get a handle on, like, okay, now we know who wins the White House. Are we going to see a flood of money coming in, like a flood of buying, or is it just going to be incremental?
Well, Alex, take away the politics. The presumptive Republican nominee, now Republican nominee, has said he wants to put a 10% tariff on all $3 trillion worth of imports that come to the United States, 60% on those emanating from China, and potentially 60% on automobiles and other products coming out of Mexico. That would change the landscape here at the Port of Los Angeles forever, and it would create inflation. On the Democratic side, what we've seen is a continuation of this tariff regime and get tough on China policy, but in very small, targeted ways. What happens to investment after this has to revolve around international and trade policy. What are we going to do to stimulate not only the continuation of that government investment, federal and state level, but how we can give confidence to the private sector to invest behind us?
Gene, nobody has a better view of China than you guys in the Port of Los Angeles. Are the boats still coming? Are they loaded as much? Because there's real concern about the Chinese economy.
Yeah, a couple things, Paul. When we concluded calendar year 2022, 57% of our business portfolio here in Los Angeles was China cargo, imports and exports. Right now, it's about 43%, yet we're still growing. We've been nimble enough here in Los Angeles to attract the cargo in Southeast and South Asia. There are more nonstop services being put in place by the shipping lines. Speed has always been our selling point. With cargo coming from Asia and distributing throughout the country, we keep these nonstop services in place. That speed variable remains in our favor.
What's your biggest problem right now, Gene? Like, what keeps you up at night?
Well, looking across the board, making sure we keep our costs in place, and we do that with a relatively expensive landscape on how we move cargo, but more volume means our unit cost becomes much more competitive, and we're trending in that direction nicely. We've got a very complex labor landscape. Our dock workers have a contract for another 5 years, but it's the truckers, warehouses, folks in IT and manufacturing we've got to keep trained up and moving with this economy. And then lastly, along the regulatory environment, got to make sure that clean air is a priority, but making sure that we're balanced, because every 4 containers here in Los Angeles creates a job.
Interesting. So, Gene, you mentioned some of your partners there, whether they're at the docks, the warehouses, the transportation, the rails and trucks. How is that supply chain? How is that logistic chain performing in your area these days?
I look at the vital statistics every morning, and after just checking in with you all, I saw that they're at or better than where they were pre-COVID, with one exception. Our on-dock rail cargo sitting a little bit longer than I would like. We're working very closely with both the Union Pacific Railroad and BNSF to make sure we have rail cars, engine power, and crewing to match this surge in cargo that we have coming now. Nothing sinister is happening on the ground, just need to keep that velocity going so the next ships, of which we have 56 on the way from Asia, can be worked expeditiously by our longshore members and then gotten off into the American economy. And that's with all this data, Paul, we see these micro and mini spikes or changes in the supply chain data so we can act much quicker than we ever have before.
Our thanks to Gene Soroka, Executive Director of the Port of Los Angeles. Coming up on the program, we'll discuss how the impact of a declining rig count in the U.S. is impacting oil production.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Emily Graffeo. This is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm Paul Sweeney.
And I'm Emily Graffeo, filling in for Alex Steele.
We move next to retail and the health of the consumer.
This week, we got earnings from retailers Kohl's, Abercrombie & Fitch, and Nordstrom, among others.
For more, guest host Michael Regan and I were joined by Mary Ross Gilbert, Bloomberg Intelligence senior equity analyst covering retail. We first asked Mary for her take on the most recent results.
I would say mixed results coming out of retailers. So, for example, on Kohl's, they missed on the sales line. So the comp sales came in down about 5%, and analysts were expecting down 2.5%. But the good news was that they beat on the bottom line, and they raised their earnings guidance for the year. So they're now expecting something closer to $2, whereas before they were expecting something less than $1.80 previously. So while that is good news, they do need to get the top line right-sided. And with Tom Kingsbury as the CEO, and has an amazing track record. He's the one who took Burlington from sort of a mall-based type discount retailer to an off-price, fast-growing company. So there's a lot of faith in him. He's bringing in a new category. The Sephora business did well. It was up low teens on a comp basis, with total beauty sales up 45%. But now we need conversion. And yes, there's headwinds from the consumer. So then if you take it over to Abercrombie, on the other side of the picture, their customer base for both brands, Hollister and the Abercrombie and Fitch brands, their household income is 100 to 150,000. Not like Kohl's where you're under 75 in household income. And so you really have to be very discerning. So an Abercrombie is executing very, very well. And that explains why they had double-digit increases in comp sales. The Abercrombie brand was up 21% on a comp basis, and you had a 15% increase on Hollister. And that's on top of double-digit increases a year ago. So that's a company that's executing very well with just great results. And then Nordstrom is sort of in that similar category. The sales were a little lighter than consensus estimated, but they had strong full price sales. That's very encouraging. And the fact that the business is actually generating positive sales, something that we're not seeing really in department stores.
You know, Mary, if I listen to everything you're saying from sort of a macroeconomics lens, I wonder if there's like a big theme to be taken away here, you know, excluding sort of the execution hits and misses from each company. But it sounds to me like, you know, those lower income consumers are struggling a little bit. The higher income consumers are still spending. I mean, is that simple takeaway? Is that too simplified, or is that really kind of the story that is emerging from the earnings season for retailers?
Yeah, I think that's fair. And even, you know, as we get up into the higher income, they're also trying to save money too. I think that you saw that in the news out last week with Walmart and Target. And so a lot of them are taking advantage of the better prices there, but that also keeps them in a good position to continue spending elsewhere, you know, so for things that are more desirable. So yes, I think clearly the lower income, lower middle income consumer, and even middle income consumer is just having a hard time dealing with high food and energy prices. And that's showing up in their very discerning spending. That's exactly what you're seeing.
You know, Mary, I sent my youngest two kids off to school, back to school already. We started early in Metuchen, but it got me thinking about that really important back to school shopping season, especially for, you know, your Abercrombies of the world. What's the outlook there? I mean, if you could break out your crystal ball and tell us what the next quarter numbers are going to look like. Do you think, is there going to be some weakness because of all these issues you're describing?
Yeah, so it's a good question. I think, once again, we'll probably have some mixed results, but Abercrombie is seeing very good reaction to some of the initial categories that they have. So, for example, in Hollister, they've got their collegiate line that they've launched, and it's more extended. It covers about 32 universities. If you look at on the Abercrombie side, they have the NFL line by Abercrombie, and they've had that. This is the third year running now, but each year they extend it further and further because the demand is so strong, and that's sort of part of their strategy. So we are seeing, I think, good results there. Now, as we start to get more media coverage of the election uncertainty, we have seen in past times around this election cycle where there is that uncertainty, it can sometimes have an impact on consumer spending. But generally, I think it's really going to come down to, those that are executing and those that are skewing to a more of a premium consumer or ones with greater discretionary income.
Our thanks to Mary Ross Gilbert, Bloomberg Intelligence Senior Equity Analyst covering retail.
We have something here at Bloomberg called Bloomberg New Energy Finance.
The idea behind it is to provide data on commodities, power, transport, industries, buildings, and agriculture.
BNEF also talks about how businesses and governments can finance and navigate change as we transition to a green energy future.
This week, we looked at U.S. oil supply. There is a falling rig count, and the question is whether we'll see falling oil production moving forward.
For more, co-host Alex Steele and I were joined by Ty Liu, BNEF Global Oil Supply Specialist. We first asked Ty to talk to us about the impact of a declining rig count.
I think the declining rig count in the U.S. that we've seen, it's not going to have that big of an impact as it seems, as much as the headline number suggests. And part of the reason is because, like, if you look at the Permian, where we have the biggest oil production region in the U.S., the well completions is only down about 4.5%. Compared to the rig count, which is down about 15%. And so, and on top of that, you have a lot of efficiency gains in the sector. So you are able to complete a lot more wells with much fewer frac crews across the industry. So I think the rig count number could be a little bit misleading if you're focusing too much on that.
So I'm surprised just looking at your report here and seeing how production in the U.S. continues to increase, but maybe at a slower rate. I don't know. I got WTI crude oil at $77. Why don't I drill some more? I can make money. I mean, it only costs those guys $40 or $50 to get it out of the ground, right?
Yeah, for sure. Yeah, so when we look at the break-evens, especially in the Permian, it's probably around in the low to mid-40s for the Midland Basin. And then for the Delaware Basin, it's probably even lower than that because they produce a lot more gas. But part of the reason is because the U.S. oil patch has really pivoted and transformed itself in the past couple of years. Now, before the pandemic, oil producers were very much focused on production growth. But after the pandemic, the industry has changed, and now they're focusing on financial returns. In order to improve their financial returns, they have to become more efficient. So in the past few years, you have seen a lot of cost-cutting initiatives, a lot of optimizations on logistics and supply chains, a lot of investments in infrastructures. So the entire industry has become a lot more efficient in the past couple of years. And on top of that, they have also become a lot more resilient. And what that means is that nowadays, the U.S. oil industry can produce a lot more oil with much lower capital investments compared to just 5 years ago.
Also, what are the cool things that oil companies are doing to extract more oil out of rock at the end of the day? I mean, I went to a conference about a year ago, and everyone was like, ooh, 3-mile laterals. And what that means is that you basically drill a pipe down, and then you drill it across the rock, basically lateral, and you fracture it. And the longer you go, in theory, the more rock you'll be able to access, and then in theory, the more oil you'll get out of that rock.
Wow. That is good.
Was that too nerdy
no,
for you?
I learned something.
No, okay, cool.
I learned that fracking is short for fracturing.
Yes.
I didn't know that.
Good job. Ding, ding. We learn things here at Bloomberg Intelligence. So based on that, what are the cool technologies that are coming up that's going to enable even more oil to come out of the rock?
Yeah, so during these longer laterals, it's definitely a big part of these efficiency gains because you are reducing a lot of the service costs when you're drilling longer laterals. And like you said, Alex, you're making a lot more contact with the source rock, so you can pull out a lot more resources from the same wellhead. Some of these, better practices would be having a lot more building out the water handling infrastructure. Some of them would be optimizing your frac designs. Some of them would be, optimizing your spacing between the wells. So a lot of these seemingly small things individually, when they act together, they can have a big impact, especially over time. For example, one of the big producers in the Permian, I was looking at the data, and they were able to reduce their the well cost per lateral foot by about 30% between 2019 and 2024. So that's a huge gain in terms of percentage.
All right, so I thought if you go into you find some shale somewhere. Don't you do your good wells, your easy wells first, and then shouldn't the productivity decline over time?
Yeah, that's exactly pretty much what we've seen. Like you said, in the U.S., the oil and gas companies, what they do is they drill the best acreage first because they want to realize the net present value of those better wells. And when we look at the data for the past 5 years, what we've seen is that oil production on a well level basis has been declining every year for the past 3-4 years, pretty much across the board. But what's interesting is that in 2024, the data that are coming in so far, they're looking different. Oil production on a well level basis is actually better for the wells that came online in 2024 compared to those last year. So what that means is that technology improvements could be turning back the tide for this production decline on a well level basis.
Which is why it's so cool. When we talk about laterals, now we're talking about 3 miles. That's a lot, and a lot can go wrong in 3 miles. Now, just about 5 years ago, the talk was like, ooh, well, if you frack here, then you're going to hurt the rock over here, and then it's going to mess up the oil distribution and all that kind of stuff. What are the problems that are emerging the longer out we go in these rocks?
I think one of the biggest risk factors, like you said, if something goes wrong, Alex, you lose production from a 3 mile worth of lateral. Yeah. So that's going to be a big opportunity cost for you. But at the same time, if things go right, you can potentially save a lot of money. I think not only they're drilling longer laterals, some of these companies, they're actually making U-turns under the ground. So they can stay within the acreage, and so they can make more contact with the source rock.
Wait, so if you do that, do they U-turn into another layer of the rock, or do they U-turn in the same layer?
They U-turn in the same layer.
Oh my God, that feels like a lot can go wrong there.
Yeah.
But what companies are doing that?
I remember Metadata Resources in the Permian is doing U-turns on the laterals, and there are a couple other ones I don't recall on top of my head.
Oh man. Well, is this nerdy enough for you?
Yeah.
That's really cool.
Well, here's my dumb question of the day.
Never.
Other than shale oil coming from shale, do we still drill old-fashioned rigs and produce oil that way?
We still do that quite a bit. But if you're talking about onshore, the productivities of these wells is probably like 10%, or maybe 20% of these horizontal wells. So the impact is definitely a lot smaller than the horizontal ones.
Our thanks to Tai Lu, BNEF Global Oil Supply Specialist.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.